Welcome back to the CNBC TV 18 special. The markets are at all-time highs. The economy is chugging along and probably being pushed by other factors like GST and a legal system and a banking system that is pushing for resolution of bad assets. Under such extraordinary times, what should an investor do? Where is the economy and the markets headed? All those questions to Mr. Leo Puri, the MD and CEO of UTI AMC. Mr. Puri, first a few questions on the economy itself. We have not yet seen signs of growth in the sense that earnings are still at single digits growth and for a year as a whole in low single digits. Maybe a certain quarter is high single digits. Would you say it is a matter of time only, or do you think we may have to wait long?
Well, the market is clearly building in an expectation that we will be at 20% plus earnings growth this year in order to get to where we are. So far that the good news has been lagging. We haven't yet seen it, so it is in the future. There are three drivers that are talked about here. One is, of course, the continued flow of consumption fueled by pay commission, price hikes, and so on. And to some extent, the wealth effect that we were talking about earlier, because obviously with asset prices going up, people feel wealthier, and when people feel wealthier, they spend more. So this has been another, I think, important and so far not fully understood phenomenon here that's driving consumption at this point. The second, which we are seeing evidence of, is the government beginning to take advantage of the healthy fisc and actually spending, and we know the sectors where that's happening, largely transportation linked and some urban infrastructure, but that's again very, very positive at this point. The third has been fairly steady FDI at this point. And we know over the last 2 years that we've been one of the favored destinations for FDI and, of course, foreign portfolio investment as well. So that has actually been a source of energy in terms of consumption as well. But, of course, we know the dog that's not barking is private sector capex here. And as of now, I don't expect that to pick up in very short order. It's partly about animal spirits. It's partly about the statistics in terms of capacity utilization. And the hard facts and the cold emotions, are between them, I think, conspiring to push this out a little more, I think, than people would like to believe. So we may be still, maybe a year away from the point at which you'll see the investment ratios start to rise, which is the basis of long-term investment. So the government will have to continue to fill that gap. I suspect that's understood in policy circles, and there's a readiness to do that at this point, which makes the quality of public governance, public execution, speed of public decision-making ever so critical during this 3 or 4 quarters, where we will continue to see, I believe we'll continue to see a very slow build-up in private sector capex, because that's a locomotive for the economy.
Okay. No, that's well said. But we also have public policy contributing in a big way to putting new pieces, new revolutionary pieces in place. GST, for instance, a tax revolution. The insolvency code, again, hopefully stemming infructuous use of the legal process. Do you think that now these will start generating manifold advantages? I mean, will second half of 2018 itself be the big rebound in earnings, or do we have to wait for 19?
I think if I took an optimistic view, I'd say what we are seeing is the beginning of a long-term commitment to actually strengthening administration and governance in the country today. So all of these things, the cooperative federalism, the GST, the beginning to put in place the insolvency code, the new thinking around education, which is underway, the renewal of urban infrastructure in cities, and sector by sector, the desire to carry out a review of regulatory frameworks, improve the quality of regulation, which has been, of course, sorely lacking in most areas. You could say, finally, India is in an environment where we understand the importance of governance as a necessary leading indicator for our long-term development. So even if these don't show immediate fruit, this could be a truly exciting development at this point, if this sustains. Okay. So I don't expect any of this to immediately, but this keeps confidence alive. If you look at where the average household in India is in terms of optimism and so on, it's actually fairly high. Why are we still getting flows at this point? At this stage in a cycle, every previous cycle, we've seen redemptions rise and people beginning to lose faith. Particularly if you look at the volatility that we had late last year and earlier this year. But people have stayed put because in general the feeling is we're in an environment where the quality of governance is actually shifting and lifestyle will therefore follow.
Okay. Therefore, you know, I mean, people have argued incorrectly that we are part of a global performance of equity as an asset class. If something were to go amiss in the global markets, global equity markets, do you still think that our downside is protected primarily because of the financialization of savings?
I don't think I think we are in a cyclical, markets are cyclical. So there is, if the definition of protection is zero downside and some form of capital protection, certainly not. I absolutely think that that would be a unhealthy assumption. Okay. I think one has to assume that there will be a downturn. One has to start to understand what one's risk appetite is for being able to tolerate that. And one has to plan for that. You know, I think the notion of, obviously greed and fear and so on are the two twins. But they need not be the only two states in which an investor operates. I think there is plenty of room in between for calm reflection. And that essentially is achieved when you think about goal setting and targets and so on, which is actually not that difficult to do, which is, it's a personal journey for people to essentially understand where they are, what goals they believe they have met or not met, and actually make honest decisions around that. And that's the real lesson for households in this market. Assume there is going to be a downturn. I don't think we should be pretending that there is a possibility that we are going to indefinitely escape the withdrawal of liquidity. The whole world is waiting for that. We know that. This is the Chuck Prince statement that while the music is playing, you can't get off the dance floor. So for global institutions, global money managers, global ETFs, that's the problem that they face. They can't leave the dance floor. Yes. But if I'm a teacher with a certain defined income in a middle-class household, I can leave the dance floor. I don't have to keep dancing.
Okay. So how should one leave the dance floor? Earlier in our chat, you referred to the fact that now there is greed towards stock markets and fear towards gold and real estate. Is it a time to reassess and come back to these physical assets in some fashion, in some percentage?
Yeah, you know, and I think this will depend on people's individual journeys. So on the one hand, we had to fight against a tendency where we systematically underinvested in equities and failed to benefit from the long-term benefit of equities. But that is segment specific. The segments who essentially tended to do that are not necessarily the segments who have been actually coming into the market. The one important difference there is that thanks to the fact that the National Pension Scheme and the EPF is coming in, indirectly, many of the people who would have resisted at all costs participating in this have in a way been forced. They've been mandated to participate. So if you were a civil servant or you were part of the EPF or you were indeed a voluntary subscriber to NPS, now whether you had thought about it or not, you are already exposed to equity markets, and I think that's been a good thing. But these are people who are exposed, let's say, to the maximum extent of 15% or whatever on average. They're still, in a sense, underweight. But there are a lot of very seasoned, and I use that term in inverted commas, so investors who've been participating in cycles who have perhaps got overinvested in equities at this point because the circle of discussion, influence, and peer acclamation leads them to essentially overinvest. And I think that's the group which probably needs to look at. If you really have started to rely on near-term gains in equity or mutual fund, equity mutual funds, as essentially providing your ongoing income, then that's a signal that you perhaps need to balance. You can use systematic withdrawal plans to actually say, as you get closer to the peak, do you want to actually start taking some part of this off the table so that your income starts to get protected? You can, of course, take financial advice and do a more formal reallocation at this point, whether it's fixed income or balance and other products that will automatically lower risk, and hopefully you can mitigate the loss in return and balance that out. But it is very critical, I think, at this point, I would keep underlining that in a market which is nearing its sort of peak valuations, historic peak valuations, you must at least ask yourselves the question as to how far away are you from goals, and what's the right point to reallocate. And at the same time, we don't want to lose the good fortune that the middle class has had, that it has for the first time participated to a relatively great extent in the strength of this country, which is its growing economy and GDP and so on. So that balance mustn't be lost. Equities are not bad, they're good, but they are not linear. They create wealth depending on your horizons and so on and so forth, as we keep saying. It's a good thing to do, but please don't confuse that with essentially a guaranteed return product or something that is risk-free.
Okay. Mr. Puri, it's a pleasure hearing you out, and I do hope your voice of caution, your voice of reason spreads far and wide, and people are prepared for both the upsides and the downsides with some kind of equanimity. Thank you very much for joining us and giving the special advice on the occasion of the Financial Advisor Awards.
Thank you, Latha.